Good afternoon, everybody. For those of you that don't know me, I am Justin Cohen, and I work alongside Barry at Barry Cohen Homes, and I will be your moderator for today's discussion. I want to thank everybody for tuning in. We've got a great turnout and sold out the event with about 500 registrants.
Wow.
Our intention, yeah, it was great. Our intention is for this to be a casual, unscripted conversation, but I can see many of you have submitted questions for us to answer. So we'll do our best to get through them all, but first I want to introduce our panelists. First, we could not be more excited to have with us today Dr. Sherry Cooper, Chief Economist of Dominion Lending Centers, formerly the Chief Economist of BMO. Sherry, I want to thank you so much for joining us, and we can't wait to get your perspective on what's going on right now.
My pleasure.
Thank you. And obviously we have my partner and father, Barry Cohen. Dad, though I get your perspective on the market daily, it'll be great for you to share it with our clients hourly. Anyways, it'll be great for you to share your perspective with our clients, followers, and Dominions as well. So with that, I'd like to turn it over to Sherry.
Well, thank you, Justin. Well, hello, everyone. This is such a difficult time at so many different levels. I have been pondering for weeks and weeks now how best to describe what I think the economic outlook would be and the financial fallout as a result of what has been and is an ongoing, devastating global health crisis that none of us saw coming and certainly is far from over. And I want to say up front that unlike some other economists, I am very reticent to put too fine a point on specific numerical forecasts of what the growth will be or the unemployment rate will be this quarter, next quarter, the quarter after, and beyond. And that is because it will be determined by the virus. And none of us know, not even the public health experts and epidemiologists, and certainly not me. So we are well into this period, but it is one that I think will come in fits and starts. I think that particularly as the United States is opening up, before the numbers of new cases and the numbers of deaths have begun to decline, there's a risk that we will actually see an acceleration in the number of new cases and the number of deaths in the coming month or two. I can say that sitting here in Toronto, as much as I, like everyone else, would love to go back to the way things used to be, I'm actually pleased that the government is taking its time and that as they do reopen, it is likely to be gradual and with considerable lags between each stage, just to make sure that we don't have a substantial resurgence and hopefully another lockdown. I mean, that would just really be devastating. So what's happened? What's happened is that the economy has gone into a medically induced coma, and it has shut down very suddenly and nearly completely. So there will be record bad numbers coming in for the economy, certainly over the current quarter. So Friday, we will see the Canadian and US jobs numbers. I'm sure that in both countries, the unemployment rate will accelerate further. For Canada, it's already moved up from 5.7% to 7.8% in March. I believe we'll see double-digit unemployment, whether, could it be 15%? Absolutely. Which would certainly be the highest in the 70-year history of the data series. We already know that the number of people registered for employment insurance is about 20 million. So in the United States, and considerably, huge numbers in Canada as well, proportionately, even bigger than what will show up in the April data, because the April jobs numbers were as of the middle of the month. So things are going, in terms of the numbers, are going to get worse before they get better. And this is still a big unknown. Now, I do applaud not just the fiscal federal government and the government at all levels in Canada, but also the Bank of Canada. I think that we've done a fantastic job of mitigating what could have been outright panic. The job right now of Trudeau, all the way down to the municipalities, as well as the Bank of Canada, is to do whatever it takes to keep financial markets fully functioning and to allow the maximum number of people possible to remain employed, or at least to remain liquid, solvent, is with some income coming in, and for the maximum number of small businesses and large businesses, for that matter, that when they do reopen, that they are sustainable. Unfortunately, we will see some of the businesses that have been shut down will not reopen. And, it's a terrible thing, but this is, the weakest among us, the most indebted among us are the ones that won't survive. And of course, from a consumption perspective, consumption in Canada is still 70% of economic activity. So consumer sentiment, household confidence has an enormous impact on the overall economy. And let's face it, consumers have got to feel upended, nervous, and concerned about the outlook and about their own personal safety. So the growth numbers that economists have been putting on the second quarter for the United States, the consensus is somewhere around, are you ready for this? Minus 40% GDP in real terms.
Yikes.
Yeah.
Wow.
And for Canada, something in the neighborhood of, the Bank of Canada said second quarter minus 15 to 30%. Bay Street's saying something like minus 40%. These are outrageously horrible numbers. But remember, it's not because of something intrinsically terrible in the economy itself or in financial markets. This is not your average financial crisis. Right. It is a financial crisis, but it has been caused exogenously by the pandemic. And so the shutdown is basically the way that we can cope with the numbers of people that have gotten sick, and to, as we all now know, to flatten the curve. So what happens next, and what does it mean, of course, for housing and real estate in general, which is the most economically sensitive sector, and of course, the most interest-sensitive sector? Well, there's some real pluses underlying this. Had it not been for the pandemic, this would probably have been the strongest spring housing market in history.
I agree.
The history
2 decades,
of the numbers. So that's very good news, that the fundamentals in the GTA and the Greater Golden Horseshoe are very, very positive. So that means that we'll have pent-up demand. People that were intending to buy or sell over the course of these months will still be there, although clearly, you know, with lots of concern and question marks. In addition, interest rates are at rock bottom lows, and they are not rising anytime in 2020 or 2021. So, and we have seen, even though initially because of the rise in risk premiums and just the fear of increased credit risk out there, that the cost of funds for banks increased very sharply in mid-March. And since then, because the Bank of Canada has been buying all kinds of securities, assets, mortgage-backed bonds, and provincial bonds, just about everything. Those numbers, the cost of funds, have come down, and the banks are cutting mortgage rates. So variable rate mortgage rates have come down as the prime has fallen 150 basis points, and as well, fixed mortgage rates have come down. And in fact, as the fixed rates are continuing to come down, and I think they'll fall a bit further, the gap between variable and fixed argues for, you know, why take the risk of variable? How much lower could rates even go? But all that aside, the fundamentals for Toronto and all of its outlying areas remains very, very positive. Toronto is the fastest growing city by population of any city in North America. Now, some of the offsets for that, of course, aside from just the direct effect of the pandemic, is that the travel bans have reduced the net inflow of immigrants, or at least potential immigrants, you know, non-permanent residents that would have come looking at different properties, certainly have not done that in the last 2 months. So that's a factor. Now, the hardest hit sectors of the economy and the largest numbers of layoffs have been in, of course, anything to do with aviation, travel of any sort, tourism, accommodation, which of course is travel related, food services, and basic bricks and mortar retailing, with the exception of the grocery stores and the drug stores. So the people that have been laid off, and some of them outright laid off, some of them furloughed, I mean, some of them it's temporary. Those are typically lower income wage earners. Often in personal services as well, it's been very hard hit. The hairstylists, the barbers, the manicurists, all of that. And all of these people, or many of these people, operate on relatively low base salaries, and they rely very heavily on tips. The reason that the federal government very quickly introduced not just employment insurance, but the CERB, is to provide a cushion for those people where they get $2,000 a month for 4 months. Almost no questions asked. Now, it doesn't cover everybody, and those in the gig economy they're supposed to be covered, but I mean, there's always people that fall through the cracks, but I do applaud that they're trying very hard. They're also trying very hard by way of subsidizing small businesses to encourage them to at least pay some portion of wages and keep people on the payrolls. So, you know, many different programs, trillions of dollars are being spent. The budget deficits for the federal and provincial governments are going to go through the moon. But with 10-year yields in Canada at not, well, what, 60 basis points? I mean, the government can afford to issue debt. and the Bank of Canada will buy as much of it as necessary and worry about the fallout way down the road. So I think
How way down the road?
well, that's the question. Now, assuming that we do gradually unlock down, I think the second quarter numbers will be the worst. So this will be the bottom of the recession. And then the question is, how quickly do we come out of it? I'm hopeful, and I've seen a lot of numbers for the third quarter of plus 30%, plus 50%. Even if we had plus 60%, by the way, because we'd be growing from such a reduced base, it would still take 3 years to get back to where we are or where we were before the pandemic. So it is going to be a long period of adjustment. But barring a relapse when the flu season, the normal flu season comes back in the fall, I would think that the second quarter will be the worst of it. Now, I have no idea whether there will be a second wave and whether the second wave will be worse than the first wave. We all know that in 1918, that is what happened. It has begun to happen in places like Singapore and Japan, where they opened up too quickly. So again, that's why I think being cautious is the right thing to do. But I'm gonna just wrap up these comments to say, there are winners in this. We are going to see structural change in our economy, and there will be new opportunities. I mean, just off the top of my head, I made a list of companies whose earnings have actually benefited from the horrible events of the last 2 months. Netflix, Loblaws, CVS, the big drugstore chain in the United States, Zoom, Clorox, Kimberly-Clark, Peloton, Qualcomm benefits from more 5G. You know, anybody who's been concerned about not broad enough broadband, now that all of us are doing Zoom conferencing and everything else online, the build out of 5G will be very beneficial for many tech companies. Cisco is another big winner. Amazon, of course, and Accenture, Booz Allen, you know, the consultants who work with businesses to literally reinvent themselves. They're not going to reopen. They're going to create a whole new platform. And I mean, just 2 days ago, BMO announced that 80% of their 36,000 workforce will work remotely at least part-time for the indefinite future. This isn't just for a month or two. So the implications are just huge. So yes, there's been pain and there will continue to be, but there are also real opportunities out there. And we're at least functioning from a real estate perspective from a very, very strong fundamental base.
So you've seen, firstly, Sherry, I want to thank you personally for coming aboard. What everybody doesn't know is Sherry's a past client and sold her house, and this was Justin's idea. Quick phone call to Sherry, and she was on board in a second. Very impressed, and thank you again very much. But anyway, so
well, look at that. Without Zoom, this event would have taken so much more to put together, right? And with technology, it's done like that.
That's right. The new normal, right? That's the new normal. But so Sherry, you know, at the risk of, you know, sounding, you know, like a blind optimist real estate agent. I mean, I've sat on so many real estate panels and we've attacked the economists, and I've never seen a panel of real estate agents ever predict a market correction. And we know there's been, I mean, I've personally seen 5, right? So I think in 81, I think it was largely due to 20% interest rates. I remember I was selling second mortgages at 22%. How could this go on? And then I think 89, there was an economy fallout, and that was significant. We lost 28 to 30%. And then I never understood the turn of the century, the computer rolling over.
The .com.
Y2K.
Yeah, the Y2K.
Y2K.
I mean, you know, I wouldn't let my clients sell at that point. And then in 2008, the media, I think, attacked real estate, and they kind of wrote the story before the facts were presented, painting Canada as the little sister to the US, and we were somehow going to have a similar fallout to the housing meltdown that went on in the States. You know, so those are the markets I saw. And then in 2018, which was 2018 was the
17.
End of 17, beginning of 18, was, you know, the government's attempt to level pricing through policy.
Yeah.
You know, the foreign buyer tax, the mortgage rules, which I was in favor of the mortgage rules, not the foreign buyer tax, as opposed to dealing with the supply issue. We have all that land that's frozen, let's bring it on. But that's a whole other discussion for another time, unless it comes up. But you seem to be more of a bull than a bear on real estate. Am I reading that right?
Well, I think, yes, as long as we don't see a real catastrophe in terms of opening up, and then the rate of disease and death just explodes again. And also, it's all about a vaccine.
Right.
And getting a vaccine, you know, I've heard we're going to have one by the end of the year, and then I've heard, well, we may never have one. They still don't have an HIV vaccine. You know, if we get a vaccine, and particularly getting treatments that will mitigate the morbidity of this disease, as well as a vaccine, then that would be very bullish for everything. The reason that I still think that the housing markets, and particularly, you know, we're talking about Toronto here, I think BC's housing market actually is going to do better than, certainly than what CMHC has just been forecasting, because BC, though they started out having more cases than Ontario, it's turned out that they've had far fewer. And they are opening up sooner, and they were kind of behind Ontario in terms of the recovery from the introduction of the B20 OSFI rules that set the qualifying rates for mortgage borrowers. But if we do gradually open up, if we begin to see in the second half of the year positive growth and a reduction in very high levels of unemployment, then I do think that we will see home sales pick up. Remember too that the disruption has impacted housing completions in this region.
Which would restrict supply.
Yeah, on the supply side. So even though that open air construction was allowed, or at least allowed in part, they still required, you know, distancing. It's estimated by the economists at CIBC that productivity in construction sites are down about 40%. And
but that's not for lack of demand. That's for lack of, I can't complete the product.
Right.
Right.
Yeah,
Exactly.
I
mean,
just
they wouldn't
logistics.
be building if it wasn't pre-sold, or 90% pre-sold. And remember, the supply chains have been so disrupted that it's very difficult to complete, because they're still waiting for things to be shipped in from all over the world.
Right.
So that all reduces the supply. In the last month of numbers, we've seen that the new listings have fallen almost as much as sales, so the price impact has been very muted. And that probably, I think, will continue for a while. And then, you know, first-time home buyers at least have the advantage that they don't have to sell anything in order to buy something. There will be, though, you know, desperate sellers. There will be forced sales because of job loss or because they bought something before they sold and then they start getting really, really nervous about it. So I wouldn't be surprised to see some price cutting at some point along the rest of this year. But I don't think we're going to see the 20 or 30% decline in home prices that we saw in the late 80s, early 90s by any stretch.
Well, we've already seen BC recovering. I mean, they're already up. And Toronto posted it was more or less flatline compared to the same time last year. Which, and I think they also reported on detached homes being down in the 4.16%, 7%, and condos down 4%, but semis and townhomes were up 4%. I think the biggest problem is that the numbers are so small, the data is so small that it can be misleading. For me, for feet on the ground, I'm not seeing price compression. I'm seeing a little jealous because, well, I personally more high end, as much as I will sell a townhome to a mansion, a lot of my product is high end, and we're just seeing a pause. We're not seeing a compression. I'm seeing, buyers are coming out of the woodwork. Sure, I'll buy it 80 cents on the dollar, but no seller's taking that, and no seller is picking up the phone and calling, I need to sell my mansion, or interesting enough, I was just looking, I often looked at, Toronto Real Estate Board used to talk about $2 million as being luxury. I actually think it should be $3 million, but I look at that $5 million range, and now I look at the $10 million range to see what the, the uber wealthy are doing. And there's a lot of intelligent people that are buying real estate, and like I've seen 4 $10 million sales reported this year. That's already a lot.
I think in March. They were all in March.
But that was in the midst of COVID, right? And then, I think last year there was 2 in 2019, but 2018 there was almost 1 per month. So, there's a market, but yet there's a void, between 4 million and 8 million is quite slushy, but they're out there. I've seen the sales. So, but the low end is strong. We're hearing multiple offers, right? We're seeing homes.
Sold the condo sight unseen, right? The condo market's still booming.
Yeah, well, that's an interesting point because, with the changes, and Barry, you should explain how one has to go about selling a property now in terms of distancing, et cetera. But with the changes, I wondered, who would ever spend a fortune on a property without physically seeing it? But then again, I'm right now living in my condo that it didn't exist when we bought it, right?
You bought it off of a floor plan. Right.
We didn't even see a model. So obviously people do it. Now, it is going to be a brave new world, and it'll take some getting used to. So how will it work in the future?
Well, right now I've sold a number of properties sight unseen, but they're below the $2 million mark. The condos that I've sold, $5 to $12 million, they need to do the walkthrough, right? Because it's there and they want to. So what are we doing? We have this new world, right? The new world is, before you get to the product, we're all launching these 3D Matterport tours, right? The walkthrough tours. And I think that cuts out a lot of the previous tire kickers. Largely, when I would do my qualifications, my answers to my questions are only as good as the answers that my co-agent got from their buyers if they should ask the question. Right. Now, the buyers on their own want to see these Matterport tours, and they're noticing, the house has, doesn't have this feature. I wanted a pool. I'm not going to look at it. I didn't want a pool, or I wanted or didn't want ravine. They're noticing, or people would show up looking for triple car garages on homes that were double cars. So I think that the buyers certainly have a lot of time, but they're doing more homework and makes them a better buyer. So when we're having fewer showings, I'm seeing qualified buyers, you know, and
The
so
buyers,
sorry, go ahead, Jess.
the buyers that are requesting viewings are really just requesting them to verify that what they're seeing online is the product, right? Like they're just confirming what they've seen and they're ready to act.
That's right. So the new normal now, Sherry, is we're showing up with gloves and masks. And, you know, I asked the same questions about travel because there are people still doing private travel. So you want to make sure that they haven't traveled. And I'm watching my sellers in the distance, hearing me ask these questions, and they feel safer, coaching the people that I will be operating handles and doors. And even though they're gloved, and they appreciate it. They know that I'm as interested in their health, in my health, as I am in their health. So we are doing these walkthrough tours, you know, social distancing, right? More so in the high end, but we're doing it daily. And that is the new normal. And I think when this passes, you can't say we'll be better off for it, but there'll be things that we've picked up from this that will continue to emerge, such as some of our marketing. You know, we are doing virtual open houses. I mean, I think that's a wonderful idea that somebody can walk through their living room. We're doing now virtual staging that the agents aren't admitting to as a real cost saver, you know, that, you know, I don't have to spend.
They just draw somebody else's furniture in.
Well, I can take, Sherry, we have a large agent audience here today too, but I can take a picture, my photos of an empty or as a messy room, send it off, and they will impose the most magnificent furniture in that room. And for a fraction of the cost.
Yeah.
Now, unfortunately, when they arrive, they are now at this, you know, potentially not so beautiful home, but it would be maybe the agent and the agent's interest to create easel pictures of what they created online and maybe set that up in the living room, in the kitchen, and remind them that this can still be so. Now, of course, there'll be the sellers demanding staging, and we will continue in that fashion and things like that. But you know, the new normal, it's really funny. It was out there. Like, you know, how many of us were fighting DocuSign, electronic signaturing? I mean, Justin tried to get me, you know, to learn this, you know, a year ago, didn't do it, right? And Zoom calls. I mean,
3 years ago. Yeah.
Okay, thanks. It's a part of my day now, the Zoom presentations, right? So I think that will continue, because I think what that does is you want, as a consumer, your time, right? As much as I want my time. And if my time now is not taken up by driving to the property as much as I used to, that means I can call more buyers. I can call more sellers, you know? So there's a lot more we can do. Sorry, Justin.
Yeah, the pandemic's allowed us, or has forced us, to be more efficient in everything we do, right? Yeah. And technology's allowing us to.
Well, that's why I think we are going to see some permanent changes in the way people work. The hardest hit are the ones that couldn't work from home. You know, you can't, a dentist can't work from home. And, you know, and waiters, servers, all the personal services. I mean, those are the people that have been hardest hit. Justin, tell me about the first-time home buyer and what this has done. Barry's in a rarefied air where $2 million, under $2 million property is relatively low priced.
Yeah, so I mean, no question, a good part of them have paused, right, and are kind of waiting and feeling things out, which, you know, is fair. But there is a significant group that is seeing this as an opportunity, because it was so competitive in the last 2 years. You know, like you found it's difficult to find a house these buyers like, but once they like it, it's even more difficult for them to secure it in the last 2 years, because they'd be competing against 8 other people. And now, you know, it depends on the price range, but now they're competing against 2 people or none, right? And so, you know, some are excited about the opportunity. and some are taking a wait and see approach, which
Well, also if people are,
some of them are really anxious because they're living with their parents and antsy and they just got to get out, but,
so you got
which is also
motivated
fair.
as well as sellers, if people are allowed to work remotely more than before, that may mean that people will see that their reasonable commute zone is a bigger space outside center city than it used to be.
Right.
So you may see, if you only have to deal with all the too many people and commuting twice a week instead of every day, it may be more doable. There's another issue out there that people talk about, given that the hardest hit places with the disease, at least in the first round, have been the densely populated municipalities like New York City. And everybody's been pushing densification, and that might begin to slow. And that people may say, hey, I want to be somewhere with a backyard and some space between me and my neighbor. That too could be, from a longer term perspective, another factor.
Yeah.
Well,
I think definitely. Sorry, go ahead.
No, it's okay. But I was going to say this whole, ask Sherry, ask Barry, ask Justin, what's in the future? I mean, the agents are being asked every day, right? And what are we doing today with our listings? And do we bring things on stream? Do we wait? Do we this? And I think what's obvious is every time that Rob Ford comes on with, just the notion of opening up something, the market activity surges.
The stock market does does better.
That's interesting.
I mean, let's face it, the stock market is a big factor here because people, their down payment is invested, or when stocks are crashing, everybody becomes deer in the headlights. Some people panic and sell at the bottom. I certainly have long been of the view that you don't try to time markets. And as tough as it is, if you have quality investments, you should leave them where they are. But if you're forced to sell in a markedly depressed market, it does mean, like a retired person, certainly it does mean that your money, you've got less to go with for the future. So that's got to affect, at least to some degree.
But that's always been the volatility in stock market, because we have to rely on someone else's good judgment, where I think a lot of people understand real estate. I remember a good friend, Ed Klein, said to me, at least when I go to Vegas, I get a drink. But what I'm noticing right now is a lot of the stock market investors are calling us up for second homes, second investments. And I'm starting to see that trend emerge, which is interesting. But anyway, what I was about to say was this, short-term and long-term prediction, not that we should be predicting, but what's the real estate market looking like? And I'm not asking you, I'm asking myself as much as I ask you, what's this market going to look like in 2 weeks, possibly where Ford has opened up, or 3 weeks, a great deal of the economy? Is that a signal for real estate to say, okay, let's just, we're back, and is activity going to emerge? And then this fear of, a reoccurrence 6 months, or in 6 months from now, are people really going to feel that, all these incentivizations and these deferrals have now matured, and now I can't pay my mortgage, and these things come up, and these are the, the kinds of questions that I've been asking about, So I have my own thoughts, and I'm sure you have yours, but I think in the short term, we are going to see, a lot of activity. Certainly not the numbers we had in the spring market. I say this is a disruption or a pause, but there'll be a late a market, hard to call it a spring market, but there'll certainly be a fall market. But the real thing is that I think that there is this pent up demand that you mentioned, Sherry. And there's, my experience is always, that a third of the marketplace needs to move because of circumstances. And that will always be a divorce, a baby, a job transfer, maybe less job transfer these days, right? A third
or job loss.
To Toronto.
Yeah, and a third that wants to move, or maybe more than that. It's probably 50% of the market that wants to. And there's that 20% speculation, right? That's out there. And that's the market that's really on hold right now too. So,
right.
So what's your thought on the short term versus the long term? And when I say long term, I'm saying, let's call 3 months short term. Let's call 6 months long term.
Okay, well, I think it's important to segment it because I think it's different for different categories of buyer. The first time buyer, if they still have jobs, and that's an if, but they, they're not going to get a mortgage if they're on employment insurance. So it has to be people that were able to work from home, that kept their jobs over this period, and have reasonably good credit. They could afford properties before this, so they are going to be able to afford it. And I think they'll continue, and it may well be that the number of buyers is more limited. The ones that are willing to go in the short term, I think will have a better time of, as Justin said, it's not just finding a property they like, but finding one that they can actually get at the price that they want. There's also lots of uncertainty around the short-term rental market versus the longer-term rentals. Airbnb became such a major factor, and now they're getting killed.
Yeah.
And so how much of that condo supply will move back into the long-term rental market? Remember, vacancy rates in the GTA have been like 1%, or less. Just ridiculously tight rental market. This may help loosen it up a bit if more of the Airbnb type rentals move back into the longer term supply. In terms of buying for investment purposes, that's where I think there's going to be a marked reduction because you don't need to do it. And even though interest rates are extremely low, it's probably still negative carry. So why do it? It just wouldn't make sense. But there's insufficient supply, period, and particularly in desirable locations or affordable locations. And so there's still that imbalance, and that hasn't changed. So 6 months from now, we'll have greater visibility about the virus, but it won't be over. In fact, I think in many ways, the world will change, has already changed. So someone said a new abnormal. We'll get used to it, but it won't be what we had before. It will be different. It's hard even to imagine now, being packed into a stadium or an auditorium or, concert hall or with 1 million people all over you shouting and screaming. It's just hard to imagine.
Yeah, for sure.
Well, I think we were obviously forced into this, and we've left the shock zone, right? And now we're adjusting. And I think as we adjust, real estate starts to equalize. And I've always felt there's, as we said, we would have had the best spring in 2 decades. There's a lot of money on the side, and I think that when Ford gets through his openings, I hardly say we'll be back to normal, but I think sales will be brisk. But I still wonder if 6 months down the road. But I don't see this, as you said, a major correction, if any. We might see, I think it was a TD Bank, Justin said real estate's supposed to go up 7%, but that's only because we
Yeah.
already started the year at 11 or 12. So I guess with their adjustment, they're still saying real estate's going up 7%. I don't know, maybe it'd be even 2% is, even flatline is good for real estate.
Yeah, I mean, you know, if you're looking at year over year, by year end, we had such a big increase in the first 3 months of this year that that you could well see even a flat line being good.
Yeah.
But you know, it's all psychological too, because if your neighbors had sold for X and you expected to get X as a seller, you're not going to be happy getting, you know, 10%, 20% below X, and similarly on the buying side. So another issue is mortgage money, and let's talk a bit about the banks. Thanks to OSFI, the banks are being encouraged, maybe one could even say forced, into allowing those in need, those with credit lines, to borrow big time. So home equity lines of credit, no doubt, have gone up. We've got the 6 months of mortgage deferrals. And of course, the bank, they didn't give that away. They all get their money back, but it is a deferral, so revenues are down. They have to put more into non-performing loan reserves. And we've seen the corporate lending numbers at the banks. It's just gone, it's like a straight vertical line up. So, and bank earnings, no doubt, will be much weaker. So, and then in the alternative lending space, as much as the Bank of Canada and CMHC have tried to enhance liquidity by buying mortgage-backed securities and everything else under the sun, there still will be, and in the private market too. I mean, we could well see some credit stringency of that, more so than we had before this big event. And the qualifying rate has come down just a touch, like not enough. And that's because it's, you know, it's not
very
a
strict
rate. And remember, OSFI said they were going to go to an actual market contract rate average plus 200 basis points, and they nixed that when all this happened. And we'll see, you know, if they go back to that. That would certainly be helpful in terms of providing more liquidity.
Funds to the market,
Yeah. But so that's another factor that is uncertain. And we just, nobody knows yet just how, as Warren Buffett says, you know, the tide has gone out. Now we have to see who's been swimming naked, you know, we just don't know. And, you know, J. Crew just declared bankruptcy, Neiman Marcus declared bankruptcy, Hertz either is or is threatening to declare bankruptcy. I mean, you know, there'll be dominoes, many dominoes.
Yeah, because banks have allowed, sorry, go ahead.
Okay, go ahead.
Because the banks are allowing people to defer their payments for 6 months, we're not going to see who really has to sell for probably another 4. Right? Because the ones that are in a tight spot. What's that?
I said, I'm a little surprised with these nationals falling so quick, you know, 2-3 months into this, because you always think of them in these great mammoth profits, but so many of them are riding the edge. It's sad.
Exactly. And let's face it, this is all just accelerating forces that were very much in play. Retail, bricks and mortar retail, and J. Crew and Neiman Marcus all have very good websites where you can buy online. So it's not just bricks and mortar, but they've all suffered because there just were too many of them, and it's too easy to buy online. And
so there has to be more competitors to Amazon, but retail. So that's where I see the big change in real estate is more in commercial. you know, the leasing and, you know, and finding tenants in these commercial opportunities, and are the tenants going to pay, you know, and things like that. And cap rates go up, to cap rates go down.
Yeah, the department stores are dinosaurs, so they're not going to be anchors anymore. Maybe Costco, but that kind of changes the whole tenor of the you know, the old-fashioned shopping center in the suburbs where, you know, you have this huge parking lot. I think that's all. It doesn't work.
Less attractive for sure.
Yeah.
So I have a more pointed to you, Sherry, because I think when we look at back to residential trends, you know, we always, or I viewed as the condos as starter opportunities. They're wonderful, you know, until you have your second kid, they're really not room. And, you know, the government has frozen all the land around the GTA because they don't want to expand with new hospitals and fire stations, and we'll throw it into Toronto, and yet Toronto's service pipe is only this big, and at some point it's going to explode. So Toronto's answer was, I'll take all those new families, new immigrants, through intensification of condos. 20-story can become 60 stories. Beckers can become a 12-story. And I think that trend still continues. And I think why we had 2 decades of price escalation was God's not making any more land. And that put pressure on single family detached homes. So I think when we get through this pause, this disruption, whatever you want to call it, those trends emerge. But my question is more, you've now transitioned into condo. And I would think, you know, that, and I should ask my son Tyler, but is there a concern, you know, pandemic wise, you know, does the geography change? How do you feel living in a condo, sharing an elevator? You know, are we looking for, you know, condos now with balconies? Like, do you have any feeling on that, or?
Yeah, it's interesting. I'm in a 25-story condo in Yorkville. So it's not like I'm at, you know, with the one that has 78 or 80 stories. But our elevators, we're only allowed 2 people in the elevator. Now, I haven't been out a lot. I have to admit, I really have been. I mean, I work from home anyway, so it was seamless for me in that regard. But like our gym in the building is closed. All common areas are closed. You can't get near the concierge or the valets. But the elevator hasn't been an issue. I've not seen anybody else in the elevator. I mean, a lot of people are really just hunkered down in their own space. And if they're, and you know, apropos your point of people always, some people want to move. If they don't really like their space, they've found out now.
Yeah.
So they may well be, you know, deciding, gee, maybe we made a mistake. But from my perspective, I can't imagine, and we do have outdoor space, but until just a week ago, who wanted to go outside on the 20th floor with the wind and the cold, right?
Right.
But I love this kind of living because I walk everywhere, and I feel it's turnkey, and it's also, to me, it's like living in New York. You can, whatever you need to do, whether it's shopping or entertainment, restaurants, going to movies, I can just walk everywhere. And I like that freedom.
So I don't see then the trend into luxury condo at the pace at which it's appreciating to change. Because I think, you know, I'm the last year of the baby boomers, right? And so, you know, our next step is a luxury condo, right? So I think
from everybody I talk to, they can't, people who are downsizing, not to really downsize, but want a large luxury condo.
A lifestyle change.
Yeah, nobody's putting away money on converting from detached to condo, so we've noticed, right?
Well, I certainly didn't, because but the per square foot cost is higher in condo than at home. So we have virtually the same amount of square feet, and all on one floor makes it seem even way bigger. But there is, I mean, it's a small percentage of the market overall,
right?
As people at Dominion Lending Centers tell me.
Right.
But talking to you guys, I know, Barry, for you, that's, as you said, under 2 mil. Well, it's nothing.
Well,
Well, it's
no,
not-
but no, yeah, but I mean, no question, buyers' demand is going to shift coming out of this, right? They're going to be looking for different things. Like there will be a group that does, like you said, want to get out of the city or get some more land, maybe further north or east or
Do
wherever.
you think architecture demands are going to change, Justin?
Yeah, for sure. Like I have, I have an open concept house, but I know, when we list these houses, we're marketing open concept as a feature, and it is to some. But there are some now that are going to see, like I'm working from home predominantly, and I have 2 young kids running around.
It's not ideal for that.
Yeah, if the shift is working more from home, then maybe open concept isn't the best layout. And we're saying perfect for entertaining. I don't know how much people are entertaining right now, or into the future, right? Like
Right now, for sure.
well, not right now, but but going forward, like people are definitely going to be looking for more of a a workspace, home office. That's going to be more of a requirement. Maybe more amenities on the property, like a pool or gym or theater. These were luxuries, and they're still obviously luxuries, but people are going to be demanding them more because they don't want to go outside to go to do these things, right?
Well, that's another thing, by the way, another sector that has benefited from this is as the health clubs have just tanked, the sellers, the purveyors of fitness equipment like Peloton, or even just, we went, we bought, dumbbells. We had all that stuff when we had a house. We got rid of it because we have a gym in our condo. Well, the gym's closed. Suddenly it's very important that we have a way to work out. And becoming more self-contained, that you don't rely so much on outside sources, and cleanliness, and just keeping things clean. Like look what they're doing in terms of the New York subway. For the first time in history, the New York subway now closes 5 hours a night so that it can be properly sanitized, and so that the essential workers on that train aren't going to get sick just from being on the train. Those kinds of things I don't think are going to change. They're talking about the new layout for airplanes. There'll be more space, and
Costs will go up.
Better job cleaning. And restaurants in Germany, the restaurants that were opened up, they could only open at 25% capacity if they were indoors. Can you imagine? Are they going to raise the prices 4 times as high? It's like get a reservation in a restaurant. It's there's so many aspects to this. It just in every respect. We're right now, we are on the precipice of a major meat shortage because of all of the problems in all of the meat packing facilities. And it'll be everything from chicken, beef to pork. It's already in the US. My mom's in Florida. She told me she went to Costco. They only let her buy 1 steak. So it's things are changing in every walk of life.
Right.
So,
Okay, so this has been great. Thank you so much. Because we're nearing the end, I just want to quickly get to a couple of questions that people have submitted. Just very quickly. One's for Barry from a fellow agent. How would you reinvent or rebrand a listing that has been on the market for 30 to 60 days in this current market?
I don't know that I would be quick to rebrand or reinvent. What agents stopped doing a decade ago is on MLS is price reductions. Instead, we now cancel listings and relaunch, which is also misleading because, Sherry, there's one of the questions you asked me when I was selling your house. Days on the market is really not measurable anymore because agents we'll cancel it and relaunch it and say sold in 5 days, but it was sold in 3 agents in 140 days, right? So,
Right.
so you know, there are third-party software or websites now that give as much or more than the Toronto Real Estate Board gives, and they track days on the market. But it's really interesting. One particular one tracks, tracks them both, but attempts on the market is more revealing than days on the market. So I think that's what's on the fear, that's what's on the minds of the sellers. Should I take my house off the market, and should I, you know, just so the clock stops? And, you know, we all know this as agents. I think that maybe 5% of the current inventory at the time that COVID came to light came off the market. 95% stayed on the market. And, you know, and these third-party softwares, the clocks are still clicking. So I think that, you know, if this particular agent was going to reinvent their listing, I would probably wait another 3 to 4 weeks. Ford will open up more segments. There'll be a bigger buyer pool. And then, yeah, I would cancel that listing, and then I would relaunch it, knowing that, you know, we're still clocking days and times. But I think that agents and buyers won't be, so how many days on the market, how many temps? I don't think it'll be top of mind, because they almost assume that really not as much has sold in the last or the preceding 3 or 4 months. So I would say just put a little bit of pause, but continue to market today, because as you know, Justin, and Tyler was like telling me about our internet. My younger son, Sherry, does condos, and well, we have a team of 15 right now, and we're all over the city from low end to high end. But in particular, the online traffic has gone through the roof, you know, on all my listings, and we can show our sellers how many people are saying, you know, when COVID passes, I want to see this house. Had they been off the market, we wouldn't have those names to follow up on later. So to that agent, just keep marketing. All this online mediums are so inexpensive, so you can, you know, we've transitioned. You know, I was a big dinosaur. We were so used to print, right? Your house was in the newspaper, and then social media came in, and we said, okay, we're going to do social media, we're going to do both. But I think the industry has made the shift. You know, we are now online, and you know, and there's a bigger audience than someone who might pick up a newspaper. Sorry.
Okay, cool. Okay, last question. This is for Sherry from an investor. Where do you see the Canadian dollar heading?
Down. Sorry.
Yeah.
Very sad about that, but yeah, and that's with respect to the U.S. dollar. And by the way, the U.S. dollar has been amazingly strong over this entire period, and every other currency has fallen with respect to the U.S. dollar. So it's held up pretty well. I mean, it's over 71 cents, and you know, 69 cents is certainly a real possibility. And not because, I mean, one thing I have not mentioned, and because I've been focusing on this region, but another massive killer for Canada has been the oil price collapse. And so everything we've said about the underlying fundamentals for housing in this region, it's the opposite in Alberta and Saskatchewan. And the whole oil sector has serious problems, and it's compounded by the concern about global warming and the fact that the United States has become a net producer of oil, a net exporter of oil even. And that's why I believe that Russia refused to cut production when the Saudis attempted, just as this pandemic was broadening. And Russia would love to put all of the Canadian and US oil companies out of business, and they may well have succeeded in putting quite a few of them out of business, and with greater consolidation. And the same thing may well be true for the steel companies. Obviously, the auto sector is reinventing itself. So And the banks, by the way, at least a couple of them have been hard hit by the problems in the energy sectors in Canada. So I think this is a sector that is not going to revive dramatically because we're headed very quickly, in my personal view, for electric cars and non-carbon emission everything. And the slowdown in air travel certainly contributes to that. But that's one factor that has been negative for the Canadian dollar as well. So I think.
Okay, we've gone over. Thank you so much, Sherry. We still have a ton of questions, but I guess it's for another call, hopefully.
I'll take a look at the questions, and I'm going to be writing a report, sherrycooper.com. I publish everything I write, and I'll certainly be writing Friday morning when we see our horrific Canadian employment data. But don't panic, don't panic. It was a temporary shutdown.
All right. Well, I'll be looking forward to it.
Thank you.
Okay, Sherry, thanks again.
Thank you so much.
Our audience, thank you so much for joining us. We hope we can bring you more interesting speakers like Sherry in the future. God bless you, Sherry. Thanks again. Thank you, Justin. Great idea.
Bye-bye.
Thank you.
Bye-bye.
Bye. Take care.